Going to be the second installment of how to backtest 101. Today, or this day, we're going to be looking at is the 6th, so it's the day after. So we're going to start all the way over from the beginning so that I can walk you through how to find these discounts and premiums to start with. And so maybe in order, we'll talk this out in order so you can write it down in your notes. The first thing that you want to do is you want to find your discount and premium. All right, so we're going to start with that. And again, we're going to end up using the same low here, the lowest low, before it turns around and starts taking these lower highs and starts making higher highs. So as it's doing that, we're making higher highs and higher highs. And we are looking at the 6th of June. And so anything to the left of my cursor we're aware of, but anything to the right we're unaware of. Okay, so we don't know that this high or these lows are being taken out by this 9 o'clock candle, okay? So we're going to target, or we're going to add the other side of this fib to the highest point that we've reached so far. And then we're going to go to the 8 o'clock candle here, and we're going to look around and see where there are resting, where there's resting liquidity pools in a premium. So if we're in a premium using the rubber band theory, where price is stretched up, we're expecting price to retrace to the middle. Okay, so at this 8 o'clock time frame, we're looking to mark out all of these swing highs that have potential liquidity sitting beneath them. So we have one right here, and we have one right here. All right, so when the 8 o'clock candle closes, then this swing high right here is solidified. Okay, so now we're going to go back down to the 1 minute chart, and we're going to look at what time these highs are taken. So if we look here, the 9:30 open is on this candle right here, and so we have not yet taken this level. So we are not looking to go long because our rubber band has already stretched up. So to bet that it's going to continue to go up would be dulling your edge. And so we wait for price to retrace up and take that level, and it takes it at 10:45. And so if we look at when price takes that level, we're then looking for a fair value gap down with a shift in market structure. All right. So a shift in market structure is an internal low in this case that is taken. And when I say taken, it means that price has traded past it or past it. So you can't, so you're, instead of making higher lows, you're making lower lows. So this happens right here. We have this internal low that's taken, and at the same time, within the 3 candles that makes up this fair value gap, 1, 2, 3, we have a fair value gap that's formed. And that fair value gap also takes out this shift in market, or this internal low, which is our shift in market structure. So drawing this out, it looks like we would have been put into the trade with our resting limit order at 10:59. So our entry is at the bottom of this fair value gap with our stop at the top of the first candle that makes up the fair value gap. So if we extend this out, we now are shooting for at least a 2-to-1 ratio. So this is the very least when we enter the trade that we're expecting it to go to. So now we're going to go over to the 1 hour chart, and we're going to talk about why we're going to be targeting certain areas. So if we look at the 9 o'clock candle, we open and then we drop down quite a bit. So we're taking out all of this liquidity out down here, right? There's liquidity here and here and here and here that's been taken. So there's not much old liquidity that we're looking for to target. The only new liquidity that we're looking for is at the bottom of this red candle right here at 9 o'clock. So that doesn't seem very realistic given the fact that we've already taken this liquidity and price is going to keep hunting more liquidity. So we've hunted this liquidity, and what does price do? Price always wants to draw to an equilibrium. So if we look at the equilibrium of the range that we have created this morning from 9 and 9 o'clock with that big run down, we can expect a 50% retracement to that level. So again, I'm basing this box on the 8 o'clock or 9 o'clock candle, excuse me, from the top of it to the bottom of it with the midpoint of the box turned on. So we have this midline turned on right here. And then we're going to look over to our 1 minute chart and think about and use this to think about where we want to put our take profit. So if you look here, this is obviously over a 2-to-1 ratio. It's a 4.26. And if we drag our box out, we hit our take profit here before we hit our stop loss. So our stop loss is 11.50 and our take profit is 49. And so we enter the trade here and then we kind of mosey around, and between 9:59 and 11:24, so 26 minutes, we hit this take profit for 49. So again, we're looking for things in a discount to go long and a premium to go short. So we're in a premium, we're above this 50% mark, so we're looking to go short. And we're looking for liquidity to be taken on the 1 hour chart. So this liquidity formed right here, which is also this line. And then when price trades above it, we start looking for a fair value gap down. But that fair value gap, when it's formed with those 3 candles, needs to take an internal low, which is also called a shift in market structure. So the market structure before this was making higher highs and higher lows. And so when we break below those lower lows, or those higher lows, and start making lower lows, that tells us that price has now changed direction. Now, this doesn't happen 100% of the time. Sometimes you get an internal low like that taken, and then it turns around and keeps going. So as you can see with this trade, you do get your profit taken, but then price turns around and trades up to this next area of liquidity. And with that, then it trades lower again. So we're looking for specific times between 9:30 and 11:30 to enter our trades, and then trades can be held past into like the 1 o'clock time frame in New York. If the trade is going on longer than that and you're in profit, odds are you should probably just close out of it. But that happens very seldomly, so it's not something you'll really have to worry about frequently. So again, we ended up with a 4.26 to 1 ratio. So that means for every $1.26 we risked, we gained 4 times that. Or for every $1 we risked, we gained 4.26. So I'll make one more video on how to backtest, and then if you have any additional questions on how you should backtest, or how far back you should backtest, or what tools to use, how to use TradingView, anything like that, please let me know, and I'm more than happy to help. We can sit in a Discord call and I can walk you through it. So for now, I'll add this as our second part to Backtesting 101 and go from there.